As we continue building from foreclosure fraud and the misuse of the foreclosure process, we now move into a closely related and equally critical topic: mortgage fraud. While foreclosure fraud often targets distressed homeowners, mortgage fraud can occur at any stage of a transaction and often involves the financing itself. This section shifts the focus from rescuing a property to obtaining or manipulating financing under false pretenses. Mortgage fraud is one of the fastest-growing white-collar crimes in the United States, and its impact reaches far beyond individual transactions. According to the Federal Bureau of Investigation, FBI, there has been a significant increase in mortgage fraud cases, with thousands of active investigations involving both individuals and large organizations. At its core, mortgage fraud is defined as a material misstatement, misrepresentation, or omission that a lender relies on when making a lending decision. This means that even small inaccuracies, if intentional and relied upon, can rise to the level of fraud. For real estate professionals, this reinforces the importance of accuracy, transparency, and documentation in every transaction. The legal consequences of mortgage fraud are severe. Individuals involved may face loss of professional licenses, significant financial penalties, and even criminal prosecution resulting in imprisonment. Under ARS, paragraph 32-2153, any involvement in fraudulent activity can result in disciplinary action against a licensee, including suspension or revocation. Two categories of mortgage fraud. Mortgage fraud is generally divided into two categories: fraud for property and fraud for profit. Understanding the difference between these categories helps agents recognize intent, scale, and risk level. Fraud for property, misrepresentation to obtain a home. Fraud for property, also known as fraud for housing, typically involves a borrower attempting to qualify for a loan they would not otherwise obtain. In these cases, the borrower often intends to live in the property and repay the loan, but misrepresents key financial information to secure approval. Common misrepresentations include overstating income, hiding debt, falsifying employment history, or inflating asset values. These actions may seem minor to the borrower, but are considered material misrepresentations because the lender relies on this information. Example: a borrower inflates their income on a loan application to meet underwriting requirements. Although they intend to make payments, the loan approval was based on false information, making it mortgage fraud. Additional variations include backward applications, where financial data is adjusted to meet lender criteria, and nominee loans, where another individual's identity is used to secure financing. Fraud for profit, systematic and intentional deception. Fraud for profit is more complex and often involves multiple parties, including real estate professionals, mortgage brokers, appraisers, or investors. The goal is not to obtain housing, but to generate illegal financial gain through manipulation of the transaction. This type of fraud often involves inflated appraisals, falsified documents, identity theft, and coordinated schemes designed to extract money from lenders. Because of its scale and impact, the FBI focuses the majority of its enforcement efforts on fraud-for-profit cases. House flipping. When it becomes fraud. While legitimate property flipping is a common investment strategy, illegal flipping involves artificially inflating property values through false appraisals and fraudulent documentation. In a fraudulent flipping scheme, a property is purchased, assigned an inflated value through manipulation, and then refinanced or resold at that inflated price. The scammers collect the difference, leaving the lender with a property worth significantly less than the loan amount. Example: a property worth $200,000 is falsely appraised at $300,000. A loan is issued based on the inflated value, and the fraud participants pocket the difference, leaving the lender at risk. This type of fraud can also impact entire neighborhoods by artificially increasing property values, leading to inflated tax assessments and market instability. Heir loans. Financing what does not exist. Heir loans represent one of the most extreme forms of mortgage fraud. These are loans issued on properties that do not exist or borrowers who are completely fictitious. In these schemes, fraudsters create fake identities, fabricate employment and credit histories, and establish false verification systems to support the illusion of legitimacy. A well-known case involved a mortgage broker who created entirely fictitious borrowers and properties, securing millions of dollars in fraudulent loans before being discovered. This highlights how sophisticated mortgage fraud can become, and why verification and due diligence are critical at every stage of a transaction. Equity skimming, stripping value from the property. Equity skimming, also known as equity stripping, involves extracting value from a property without regard for the borrower's long-term financial stability. In a common scenario, a straw buyer is used to obtain financing through false documentation. After closing, ownership is transferred to an investor who collects rent and may take out additional loans against the property. The mortgage payments are often neglected, leading to foreclosure. Another variation involves repeatedly refinancing a borrower's loan, each time increasing the loan amount and generating fees for the perpetrator. Eventually, the borrower can no longer sustain the payments and defaults. Example: a homeowner with significant equity is convinced to refinance multiple times. Each refinance increases the loan balance while stripping equity, ultimately leading to foreclosure. Connecting mortgage fraud to professional responsibility. As we tie this section back to the broader themes of the course, one concept remains consistent. Real estate professionals are on the front lines of risk detection. Mortgage fraud may involve lenders, borrowers, and third parties, but agents play a critical role in recognizing irregularities and protecting their clients. Under AAC R428-1101, agents must exercise reasonable care and avoid participating in or facilitating misrepresentation. This includes verifying information when appropriate, questioning inconsistencies, and recommending professional assistance when needed. Just as we have seen with environmental issues, structural inspections, and foreclosure fraud, the goal is not to become the expert in every field, but to recognize when something is wrong and take appropriate action. As we move into the next section, we will bring all of these concepts together by focusing on ethics and real-world decision-making, particularly in complex and high-risk transactions where environmental issues, structural concerns, and fraud often intersect. Online discussion. Why is mortgage fraud considered more complex than foreclosure fraud? Answer: because it often involves multiple parties, including professionals, and relies on coordinated misrepresentation within the financing process rather than a single deceptive act. What is the key difference between fraud for property and fraud for profit? Answer: fraud for property involves a borrower trying to obtain a home through misrepresentation, while fraud for profit involves intentional schemes designed to generate financial gain, often involving multiple participants. How can a real estate agent help prevent mortgage fraud in a transaction? Answer: by identifying inconsistencies, ensuring accurate documentation, questioning unusual activity, and recommending professional verification when necessary.